All right, all right. Good morning, trade pros. Welcome to our morning market update for Wednesday, December the 19th. I know, man. We got 6 days until Christmas, until Santa Claus lands on our roofs and drops presents down our chute, and we got to give him cookies and milk. I want cookies and milk. Forget Santa. I'm wearing the hat. Um, just kidding. In our morning market update today, we're going to talk about nothing important. There's nothing going on today that you should know about in the market. Have a good day. Oh, yeah. The FOMC meeting. One of the most important days of the quarter. The Federal Reserve will be potentially raising rates today, 2 p.m. Actually, they will be raising rates. It's pretty much baked in. There's some expectation most recently that they may delay it because of market volatility. I don't think the Fed cares. We'll talk about that and more. Okay, first, the morning market fun fact. Victoria, ready for fun? On this day in 1927, the Dow Industrials closed above 200 for the first time. Yeah, above 200 for the first time, finishing the day at 200.93. It's two decimal places for the quotes there. Right now, it's to a point. It had taken the Dow nearly 22 years to double from 100. The index closed at 23,675.64 on Tuesday. Actually, they still do two decimals. Irrelevant, but hey, here's some market levels for you. The S&P 500 yesterday hit a low at 2530. What makes that so key? The fact that 2529 was the February 2018 low. Yesterday, we were that close, within 1 point of hitting 2018 year lows. We're not talking about positive or negative for the year here. We're talking about a bigger sell off underneath the lows of the year. You guys remember how bad 2018 started off through January, February? Well, now we're seeing that sell off hit back down to that level, right? We're down 7.3% yesterday. That's on oil. Okay. We closed at 25.31 half in actual trade. So we closed within 2 points of the 2018 lows, and we had a very bearish day. We pushed it lower and closed down there. All right. Overnight low retested 25.31 and then rallied to 25.6275 at the overnight high. But we're still below the 25.69 half level, which is yesterday's open. So we had a very bearish day. It took us to the 2018 annual lows, and we rallied off of that level. And now it's waiting. The market's waiting for the Fed. I'll tell you guys this morning. The opportunities in the morning may be slim because money is waiting for the afternoon. Yesterday, if you sold to get out of the market, there's a slim chance you're going to be buying before the Fed. You're going to probably now wait for the Fed to make your next move if you're an institutional trader. There might be a little bit more selling ahead of the announcement or buying to reposition portfolios, but I think the real opportunity lies in the afternoon around 2 p.m. Okay, we'll talk about the Fed in a moment. Oil hit the previous day low at 46.11 yesterday, 46.11, and that's down 7.3%. The S&P wasn't. I had the 7.3 down under S&P 500. I'm like, wait, what? And I created the note and caught myself off guard. That's life. We hit the lowest levels in over 1 year, and we had a 3.5 million barrel build in the API. You guys remember why that's important? Last week, the API was a draw of 10.4 million barrels. That's a huge reversal of sentiment from the draw side to positive build territory, which is bearish. All right, more supply. Gasoline came out at plus 1.8 million, so that's also build, more supply. So market got pushed bearish on that news. It closed yesterday at 46.27 on the pit session. The overnight low was formed at 46.30. We're currently trading at the overnight high above 47.06, consolidating today, waiting for the crude oil announcement at 10:30. And I think that's where the opportunity is going to be. This morning, crude oil, the inventory report, because there's so much movement, will have a lot of impact, whether it's a big miss or a big gain or whatever. If it's a build, if it's a draw, if it's nothing, there's going to be a big impact because there's a lot of expectations around it and a lot of volatility leading up into it, which means positions and portfolios are realigned, producers have hedged, a whole bunch of stuff goes on in that market, and it's mainly supply and demand driven. Okay, so that's at 10:30 today. So if I got to wait till 10:30 for a trade, I'm going to do it because on the oil report, you can make your entire weekly income in 1 day, 1 hour of that 1 day within one trade than 1 minute. I want to get a little bit more dramatic today. So there you go. All right. US dollar 96.60 support level for today's session. Fed will definitely impact this rate and these levels. a dovish tone or the likelihood of less or peeling back or slowing down the interest rate hike cycle will cause the US dollar to drop. Indication that the Federal Reserve doesn't care about the stock market and continues to raise rates will cause the US dollar to appreciate because you earn more interest for holding the dollar. All right. In today's markets, in Asia, China is up, or Hong Kong's up 0.2, China down 1.1%. In Europe, at midday, all markets up across the board, between 0.6 to 0.9%. United States, they're all across the board by 0.8%. It's almost 1%. And crude oil, like we said, was down 7% from yesterday. Or yesterday was down 7, down about 0.3 today, but rebounding. Gold is flat. Bitcoin's up 10% to 38.16. It's a pretty nice rally out of Bitcoin, and we're going to see if a little bit more volume could push it higher. All right, in today's calendar, we got a lot of stuff. 10 a.m., we got existing home sales. 10:30, we got the Department of Energy's inventory reports for oil. 2 p.m., we have the FOMC announcement. We also have the economic forecast. And 2:30, we have Jerome Powell press conference. Okay, let's talk about the Fed, because this is very important and it'll occupy the remainder of our morning market update. The Federal Reserve today is expected to raise interest rates. The question is not whether or not they're going to raise rates. The rate raise is pretty much already factored in, so the Fed's going to do it. And if they don't, that's going to be a huge shocker. And I don't think that's the outcome that we're going to spend time talking about. It's not likely. They're going to hike rates. That's a given. The real important thing is, what does the forecast look like for 2019? What is the economic projection? What does the dot plot look like, which is the future intent to increase interest rates? What is Jerome Powell's tone and other Fed voters' tone look like in the minutes? So 2 p.m., we get the decision and the minutes. At 2:30 p.m., the press conference begins, where Jerome Powell will be asked open-ended questions. What he says will be very important. From 2 to about 2:10 to 2:15, you're going to get a little bit of a move on the minutes. It might be dramatic, it may not be, but I think the real insight is to how Jerome Powell answers, because he's been the driver behind all this. You guys remember in September, Jerome Powell said we're really far from the neutral rate being the one that neither hinders nor supports the economy. That we're really far from the neutral rate, which means they have a lot of hikes to do. The market panicked, sold off. That was the beginning of the October crash. And if you look at what he said in November, he said, oh, we're pretty close to the neutral rate. And the market didn't really care. Shrug that off. It's like you've already said we're far, and now we're starting to anticipate a more dovish tone for 2019. We at one point the markets expect to see 4 interest rate hikes. Now we're down to 3 as the consensus, and even now we're down to almost 2. And some people are saying there's going to be no hikes in January of 2019. So today they're expected to raise the rates by 1/4 point. The Federal Reserve. And we're looking for the dot plot change going forward, and how Jerome Powell defends and backs that up. All right. Donald Trump warned the central bank that it must tread carefully in order to avoid making yet another mistake. So Donald Trump very clearly blaming the stock market crash of October on Jerome Powell and the Federal Reserve. And if you think that using the word crash is dramatic, you need to start looking at some more information. This is a crash at this point. All right. There's a lot of concern that there's going to be more downside. There's a lack of institutional volume on the upside. Big money is not buying dips. BTFD is over. All right. That's STFR is in place. Sell the F and rip. That's what's taking place. If you look at it on the intraday charts, you look at where the volume is, that's what institutional money is doing. They're using every rally as an opportunity to exit. That's why these rallies are very short-lived, temporary, and few and far in between. This will be the 4th hike this year. So the Fed's hiked 4 times in a row, and the 9th Fed hike since the cycle began in December of 2015. So 9 hikes of 1/4 point each puts us at, Victoria, you're good at math. How many points is that? 2 1/4. He's not fast enough. 2 1/4 points. Gotta catch off guard. 2 1/4 point hike since 2015 to December. All right, that's what we're looking at. Yeah, exactly. 4 of them being this year, 4 consecutive hikes. So it'd be interesting to see what the outlook is for 2019. I'll tell you this: The European Central Bank, Victoria knows this better because I was reading about it the other day, at the height of their stimulus was buying $85 billion worth of bonds on a monthly basis. And now they've wound it down to 50. And at the end of December, which is pretty much in a couple of days, they're going to completely end the program. They will no longer be buying bonds. So now it's not just the Fed unwinding their balance sheet and hiking rates. ECB is jumping on board. The Bank of Japan has reduced their bond purchasing program as well. The Bank of England is making the same such play. And the Federal Reserve is not only not buying bonds, not only are they just not renewing bonds, they're actually selling bonds on the open market. So we're coming into a global liquidity drain here from all central banks. And that's the part that's less talked about, but I think more important for the market. If you look at the Federal Reserve and how they've dictated and changed monetary policy, it's only been since the 2008 market crash that have they used stimulus in that way. And also, traditionally, they would affect rates more by moving and adding liquidity. Nowadays, it's the FFR, but the bigger with the federal funds rate, but the bigger change happens behind the scene on that balance sheet as it gets unwound. All right, because what the Fed's doing is they're pushing the short end of the interest rates up. So the short end being 6 months, 1 year, 2-year notes. Those are the ones that get the most amount of lift because they're the most, they move the most because they're impacted the most by interest rate that happens immediately. The 30 year is not as impacted. The Fed's pushing the front end of the yield curve while the back end, the market controls and regulates. That's being pushed down. And that's inverting the yield curve. Every time it's happened, there's been a recession. We're this close to it happening on the 10-year and 2-year spread. And we've already got an inversion on the 3 and the 5. So very, very, very interesting stuff here. Ton of people watching this. This is the most important Fed hike and press conference since 2015 when they first announced the hike cycle, because it could be coming to an end or it could be continuing. How Fed Powell feels is how the market will react. You guys trade careful out there, manage your risk. We will be trading this event with our elite team starting at 1:45 p.m. Eastern. If you want to trade it with us, you got to become an elite member. Check out our website, TRADEPROacademy.com. If you're deciding that this is a time that you want to go alone, you want to go to the great battle with a knife, that's fine. I have an M16, but we're not fighting against each other. We're fighting together. You're only coming with a knife. Maybe we'll put you in the back. But the thing I was going to tell you is if you're choosing to do this alone, Victorio's come up with a video on YouTube on Sunday, right? Or is it Saturday? Whatever. He posts Sunday. He posts one on Sunday, and he walks you through step by step on how we trade this. That link is in the description of this YouTube video. Go check that out. And you should join us. You should trade in the community, because if you look at every professional trader, the one thing they have that you don't is each other. You look at any professional environment, they're all sitting next to one another. They have the community and they have the ability to interact and get other people's opinion. And that's way too often overlooked and the single best benefit to any trader's development. See you guys tomorrow. Have yourself a great day. Huge day ahead of us. We'll give you the breakdown tomorrow for elite members, 1:45. We're going to start a webinar tonight or today, this afternoon. Super stoked. You guys take care. Have a great day. I got to turn around and open the trading room. Goodbye. Thanks for tuning in. Ciao. Ho, 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 Marky. Ho, ho, ho. Merry Christmas. Thanks there, Marky. All right, YouTube, I bid you farewell. We now got to start trading. Appreciate you guys. Thanks for watching. Goodbye. All right, trade pros in the room. Let's map out some levels and our first trade ideas for the opening bell. Then we'll pass it off to Victoria to talk about NASDAQ. Steven will do the oil, our oil desk, and we're going to get through, set up some trade ideas. And we're seeing some order flow change right now and flowing through in the market. Let's analyze it, set levels and opportunities, and get started. We're going to have a great day ahead of us. A lot of news and a lot of everything. See you soon.